Hello everyone, welcome to our third video in our first module about the stock market. This video will be talking about stocks, and we'll give a brief intro of what exactly stocks are and the various types of stocks that you'll see in the market. First off, we will be talking about what a stock is. In simple terms, a stock is a type of investment that represents an ownership share in a company. When you purchase a stock, you are purchasing a small portion of the company. How many stocks you own of a particular company divided by the total stocks of a company available is your ownership of the company. Some examples of stocks include Tesla and Spotify. Stocks can be further split into two categories: common stock and preferred stock. Common stocks are generally the types of stocks most people know about and usually grant voting rights to the shareholders on issues brought about by the board of directors. The amount of votes a shareholder gets is proportional to the amount of stock they own in that particular company. However, in the case of a common stock, when it comes to the pay of a stock, the owners of common stocks are paid last. Usually, and also the value of these stocks are regulated by the supply and demand of the market. An example of a company that has common stock is Wells Fargo. Next up, we'll be talking about preferred stocks. Preferred stocks don't get voting rights as common stock owners do, but preferred stock owners have a greater claim to the company's assets. These stocks are given priority over common stocks, which means when it comes in terms of pay, the preferred stockholder will be paid before a common stockholder. The value of preferred stocks usually fluctuate with interest rates, and they usually come with the callability feature, which allows for a redeeming of a share after a predetermined time. A few examples of companies that give preferred stocks are the Bank of America and MetLife. Next up, we will be talking about bonds. A bond is a fixed income instrument that represents a loan made by an investor to a borrower, usually the government and various companies. Bonds are primarily issued as a way to collect money or capital very quickly. Bonds have maturity dates, which means the initial investment made by the investor must be paid back to the investor in full. Bonds are inversely correlated with interest rates, which means if an interest rate goes up, the price of a bond falls. An example of a bond in the US would be a treasury bond, or a T-bond for short. T-bonds are a long-term bond that have a maturity of 10 to 30 years. Next, we'll be talking about equities. Equity is typically referred to as shareholder equity, also known as the shareholder's equity or owner's equity for privately held companies. Equity usually represents the amount of money that would be returned to a company's shareholders if all of the assets were liquidated and all of the company's debt was paid off. The formula for equity is total assets minus total liabilities. Next up, we'll be talking about dividends. Dividends are just a distribution of a portion of a company's earnings and are typically managed by the company's board of directors. Dividends can usually be paid out either as cash or additional stock. Dividends have to be approved by shareholders. With cash dividends have to be approved by shareholders, and the most common type of dividend is usually the cash dividend. Larger companies with predictable profits typically generate the best dividends. A good example for paying dividends that'll pay rather regularly are the healthcare sector and the utility sector. Next, we will be talking about volatility. Volatility refers to the amount of risk related to changes in a security's value. In times of uncertainty, volatility typically tends to run high. A higher volatility just means the changes in value are high of a stock, while lower volatility means the change would be much smaller. Volatility can also be thought of as a type of standard deviation. Usually, in terms of volatility is more of an unpredictable thing. When you're buying a stock, you'd prefer to have a lower volatility, because with high volatility, there's a lot of fluctuation going on. But with lower volatility, the fluctuation is more constant, meaning it's more predictable to predict prices and make a smart investment. Next, we will be talking about initial public offerings, or IPOs. IPOs refer to the process of offering shares of a private corporation to the public in a new stock issuance. This allows an organization to raise capital from new public investors and usually signifies a stage of growth for companies. It's usually when a company reaches a private valuation of $1 billion. IPOs usually make a company more credible when it comes to share listing. Another thing to know is an IPO is a signification of of a company going from a private ownership to a public ownership. So when a company becomes an IPO, it's not only it has reached a certain valuation, it also signifies a change in types of ownership they have. They're going from private to public. Some examples of IPOs are Visa and Facebook. Finally, we'll be talking about the price to earnings ratio, or the PE ratio for short. The ratio for valuing a company that measures its current share price relative to its per share earnings defines the PE ratio. The formula for a PE ratio is the market value per share divided by the earnings per share. A high PE ratio usually means investors expect higher earnings and are willing to pay more to buy a stock. However, a high ratio can also indicate a stock being overvalued, which runs the risk of losing an investor's money if it doesn't meet the higher earnings or predictions of that particular stock. In contrast, a low PE ratio means that investors expect less earnings and are willing to pay less to buy a stock. However, a low ratio can indicate a stock being undervalued, which can lead to investors buying the stock at a lower price and still making a profit if the stock climbs. Conversely, a low ratio can sometimes mean a lack of growth potential. A high PE ratio and a low PE ratio are both not bad nor good things, but are dependent on how someone can perceive them. So it is very important to understand this concept, because it doesn't matter in terms of what the ratio is. You have to understand how what the number of the ratio yields. So usually if the ratio is greater than 15, it means that the stock is not worth the price of buying it. Historically, the average PE ratio ranges from 13 to 15. In context, this means when your ratio is less than 15, it's well worth making a decision to buy that stock, and you have a better chance of making a profit. While if it's above 15, yes, you may be able to make a profit, but the chance of the stock being overvalued is quite high, which is something investors should avoid, because when a stock is overvalued, as mentioned before, there's a good chance if it's overvalued, it's harder to actually make the predicted income possible, because overvaluing skews the amount actually given. Thanks for watching, everyone, and stay tuned for further videos.